Do you own life insurance? If you do, pat yourself on the back. If you don't, why not? Nobody has the right to question your love for your family. I'm sure we all love our families. And I'm sure we all want to do the right thing for our families. And I'm sure we all know that we don't have a handle on how long we're going to live. The one thing we have a handle on is how we can plan for the financial continuity of our loved ones. Nigerians like high-sounding, impressive sound bites like, oh, I play the stock market, I invest in real estate, I invest in great. I invest in Bitcoins, great. All those investments are great. Then they also like saying, I've established a college fund for my children, great. But whether it's real estate, whether it's the stock markets, whether it's the college fund, whatsoever it is, the cornerstone for investing, the way that Americans who do it right do it, the cornerstone for all your investing is life insurance. Today we're going to talk about life insurance and other retirement investments. But the cornerstone of our discussion today is life insurance, and you're going to find out why. But I cannot take a break without telling you that the goal today is to make you uncomfortable. It's not you, it's all of us. This is not a critical episode. It's an awakening episode. If you die today, have you done what you need to do to ensure that you don't inconvenience your wife, your husband, your children financially? And have you done what it takes not to put your family in a desperate situation where they have to depend on the community coming together to contribute money to bury you? Our culture calls for the community to come and condole with our families when we die. There's no question about that. But that condolence should be a voluntary thing and not what Igbos will say, kan wali fele no, kan rapwe wali fele no wala. Because a lot of times the community that the pressure is put on with these Zelle appeals day after day after day, some are stretching just not to feel left out. But in the process of stretching, they are robbing Peter to pay Paul. It's all our responsibility to ensure that we bury our loved ones responsibly without desperately setting up Zelle accounts, especially for situations that happen in America after we've lived here 10, 15, 20 years and beyond. Hello, everybody. Once again, this is Fred Nwankwo coming to you from our studios in Chicago with another edition of Bold Talk on Island TV. And as usual, I like to say good morning, good afternoon, and good evening to you, depending on where you are around the world. Today, we're going to talk about three major things. Some of them may have subsections. The first thing we're going to talk about is life insurance ownership or lack thereof. The next thing we're going to talk about is abuse of the concept of committee of friends. In this case, I'm talking about where I live in the United States. And I'm sure the same thing applies to Nigerian communities across the world. And when I talk about the abuse of the committee of friends concept, it extends into the issue of setting up Zelle appeal accounts. And the third area we're going to talk about today is retirement planning. Qualified plans like 401ks, even your social security income. I am a social observer. My work revolves around what I observe in my everyday life, and I talk about it on my YouTube channel. But does any of you, my viewers, really know that over the last 37 years, I've been in the life insurance business and I've been handling 401k rollovers for my clients who move from one job to the other. And I've been talking with people in our community about the need to make sure that they're able to maximize their social security benefits and the right time to start withdrawing from their social security benefits. I typically don't approach people in the Nigerian community especially to talk about these investments, life insurance, 401ks and stuff. The reason being that through the years, I've observed that the best way to deal with our community is to make them aware of what you do, but leave them alone. At the right time, they may or they may not call you. But the bottom line is that within our community, we have a lot of assets like myself. It doesn't have to be me, but it's important that we call one of those assets within our community to sit down and at least listen to what the options could be. Your options in life insurance, your options in 401ks, your options on how to roll over your 401k when you leave one company for the other. These things we could sit down and talk about. And based on that discussion, you could make a decision if you want to work with this person or not. I do have quite a few clients in the community that I've built up over the last 37 years. And I take a lot of pride in saying that I haven't let one of them down from a professional standpoint. And that's something I'm very proud of. Now, let's go one by one. Why don't you own life insurance? Is it because of your health? If it's because of your health, you may need to call your agent, whoever you talked to in the past, and reopen your application, because underwriting has gotten more liberal, and I've seen policies approved for diabetic patients, depending on what type of what kind of issue they have. I've seen policies approved for heart patients, depending on the extent of the heart issues, and I've seen policies approved for high blood pressure patients. High blood pressure doesn't stop you from getting life insurance if you're seeing your doctor regularly and you're taking your meds regularly. Is it because of the premium? The money is not there to pay the premiums? Is it because you have group coverage at work, so you don't need additional life insurance? Is it because you're scared that if you take out life insurance, your wife is going to kill you to get the money, or your husband is going to kill you to get the money? I told you I'll make you uncomfortable today, and I'll address all those one by one. Or is it because it only pays when you die, a natural death, and you're not going to be alive to enjoy the money? Let's begin with that last point. The myth that life insurance only pays when you die. That's half the truth. It depends on what life insurance you buy. Life insurance can be very cheap. And the one that is very cheap is the one that only pays when you die. It's called term insurance. It's like renting an apartment. If you rent an apartment, you live in that apartment for 10 years. You put down a security deposit when you moved in. Your rent is $1,000 a month, $12,000 a year. At the end of 10 years, you paid $120,000 to the landlord. And you know the rent went up, but we're being conservative. When you move out after 10 years, you don't get a penny back. But if you buy a house instead of renting an apartment, and your mortgage is $1,000 a month, at the end of 10 years, you've paid $120,000 into that mortgage. And if you decide to sell the house, assuming you bought the house for $150,000, after 10 years, the house is now worth $175,000 or $200,000. You sell the house, the bank takes their money. Because you've paid for 10 years, you're going to get a significant amount of the money back while you are alive. The same thing applies to life insurance. If you buy term insurance, it's only good when you die to pay your family. If you cancel it after 10 years, you put money into it, you don't get a penny back. But if you buy permanent life insurance, I said permanent life insurance, people will say whole life, some say universal life, some say variable life. Those are different types of permanent life insurance. Bottom line is that they are permanent. As long as you pay your premiums, they are never going to lapse. So if you live till 100 years old, it's going to be here. It's not term. With term insurance, if it's a 10-year term, after 10 years, they cancel it. You have to start a new one. Now, with permanent life insurance, the kind I've sold to every client that I've sold life insurance in the last 5 years, the plan I sold them has an inbuilt rider that if you get critically ill and you are unable to perform 2 out of your 6 or 7 daily activities, which includes ability to walk, ability to use your eyes, ability to hear, ability to feed yourself, ability to go to the toilet by yourself. If you lose 2 out of the 7 ADLs, activities of daily living, if you have a $500,000 life insurance and you are not able to take care of your monthly bills, the insurance company has a rider where you could come in and apply for it. No questions asked. The only question asked is of your doctor and the insurance company doctor. And there's a scale to look at it, so it's not based on any bias. If it's found that you're not able to do those two things, they're going to start paying you 2% of the total death benefit every month until you use up 90% of the death benefit. Which means that if you have a $500,000 policy, they're going to start paying you $10,000 every month until you use 90%. So life insurance is not for the living when you die. You could take advantage of life insurance while you are alive. But then when you die with that same permanent life insurance that started out at $500,000 and you die 20 years later, depending on what kind of setup they have with it, it could be growing so that you now have more than $500,000 that they are going to pay your family. Your family can respectfully, beautifully bury you when you die. People come to condole with them, whether they come with anything or not. They come with condolence, to condole with your family without the pressure of having to give something if they don't have something. That's that aspect of it. The other part is people say they don't have money. We've covered that. It doesn't have to be expensive. Permanent insurance is pricier. Term insurance is not as pricey. You have group coverage. Excellent. Everywhere you work, you should take advantage of everything they give you free or cheap. It's your right. But remember that if you leave that company and go to another company, even if that group life insurance you have is portable, which means that you could move it to, you could take it with you and pay your premiums, but the premiums are not going to be the cheap premium you're paying. Most people pay less than $10 a month for their group life insurance at work, and it could be up to $100,000. For $500,000, you're probably paying $25 or less, or $20 or less. But if you change jobs and you want to take that insurance with you at the age you are, what you're paying $10 a month for may cost you $250, $300 because you're paying a group rate based on term. They're going to let you take that insurance based on a permanent plan. The premiums are higher, you're older, so your premiums are more. So yes, your group life insurance, even if you have the private one, you should have your group. But don't take the group in lieu of the private life insurance. You still need personal life insurance to be sure that your life insurance is there when your family needs it. And many people who say they have group life insurance and that's why they don't need, they're lying to themselves. They're just avoiding talking to an insurance agent because they don't want to take care of a responsibility that they need to take care of. Remember, I said I'll make you uncomfortable. I don't care what you think, but I'm telling you the truth. I will make you uncomfortable. You need life insurance. You don't need to call me. Call a life insurance agent and give your family the peace of mind they need, regardless of whether you live till 100 years or if you go tomorrow. Now, the Zelle thing, when you set up Zelle and people have to contribute money, it's okay. I've lost loved ones. My close friends came to condole with me, but how many close friends do I have? Who has 100 close friends, let alone 500 close friends? But I see the list that comes out on this committee of friends thing. You're throwing people's names into a committee of friends that they're not your friends. They are people you know. If they hear that something happened to you and they feel they're going to come, but you don't have to commit them to a list that you didn't get their permission to put their name in. It's wrong. I don't care which way you look at it. And these things are now coming out almost on a daily basis. I don't know about other people, but I'm an average earner. I'm not a poor man, but I'm not a wealthy man. That's a lot of money. And sometimes you're doing these things because it's almost like an obligation. It shouldn't be an obligation. We need to do things the right way. And the right way is to do what people in our community, in the place we live, do. The way people are buried is people die, life insurance pays money into the family. That's the right way to handle life insurance issues. And we need to change this mentality. I'm not criticizing our people. We're all in this together. Life insurance is not our culture in Africa. But now we live in America. And we are smart people. We have bachelors and masters and PhDs. We learn what we choose to learn and pretend the other one doesn't exist, even though we know it exists. Now, let me put an addendum. I'm not talking about our parents when we lose our parents back home in Africa. It's okay to reach out or for friends to reach out to you. But even in Africa, when people die in my hometown, people come to condole with the families. But the people, even within your own town, not everybody in the town comes because your mom died or your dad died. Not everybody is friends with your family. Some who are not friends will come, but it's not obligatory. So why are you making it an obligation and sticking people's names into a Zelle list, people who you don't know? It's not right. And this goes especially for people who hardly come out to anything anybody is doing. And then something happens to them. Somebody who comes out in the community creates a committee of friends and sticks people's names in there without permission. That's called reaping where you didn't sow. It's wrong. Now let's go to retirement planning, 401ks. I tell my clients, if you start working, you should go to the Human Resources Department and see what benefits you have. I'm finding now that quite a good number of our well-earning people in our communities, I don't want to pick any career, but I have some in mind, but I wouldn't mention it. Many of them don't sign into the 401k plans at the companies where they work. And I ask why. And the answer is that many people in our community talk to the wrong people to advise them on things those people don't know anything about, but they have an opinion on it. If you're sick and you have heart issues, even though I may know about heart issues that I read of, but I'm not a cardiologist. You're not even going to talk to your family practitioner about your heart issues. The most you'll do with your family practitioner is to mention it to him so he could refer you to a cardiologist who specializes in addressing things that have to do with the heart. So why are you talking to a fellow Nigerian who you work with who tells you, oh, forget that 401k, they just want to take your money? Oh, really? They want to take your money. Most companies, almost every company every big, significantly established company has a match on their 401k. So if you're making, I'll take a round number, $100,000 a year, and the company you work for is matching 6% of your income, why wouldn't you put $6,000, at least $6,000 into your 401k? It's your money. Nobody is taking it from you. It's money being saved for your retirement. If you put $6,000, which is 6% of $100,000, the company you're working for will put another $6,000 to match your six. So for that year, they are really not paying you $100,000. They are paying you $106,000. You're getting free money. But when you choose not to sign up for the 401k, you're leaving money, free money on the table. But that's just 1 year. The next year you put 6,000, they put another 6,000. So you don't have 12,000, you have 24,000. The next year you put 6,000, they put 6,000. You don't have 18,000, you have 36,000. But no, you don't have 36,000. Remember, the money is being compounded. 401k is the simplest way to understand the power of compound interest. Because when you keep putting this money in and the interest is being compounded over a 35-year period, this is how you have people who started at a company at 25, 30 years old, let's say 30, put in just $100 every pay period into their 401k for 35 years, and the company is matching, and at retirement, they have $500,000 in their 401k. They have $1 million. I intentionally did that discrepancy between 500,000 and 1 million, because here is where your risk tolerance comes in. Every time you set up your 401k with your human resources department, they don't just put your money anywhere they want to. They put the money based on your risk tolerance. Somebody could be conservative, they don't want to take any risk, and they'll put your money in the least aggressive instruments. Typically, those least aggressive ones will be growing at about 4 or 5%. Some people are moderate investors. They put the money into moderately aggressive instruments. Some are aggressive. They put the money into the aggressive. Now, it doesn't matter what your risk tolerance is. What's important is that they put the money where you're comfortable. Now, this is where the discrepancy comes in. Historically, even with all the ebbs and flows in the American economy over the last 30 years, the bottom line is that the American markets have been predictable to a good extent. So a person who is putting their money into an aggressive investment may be earning interest at 8 and 9 and 10, sometimes 12, 15% on what they are investing in. But remember, those are also, when you hear that the market went down, those are also the ones who their investments go down proportionately with the market. So your heart has to be strong. Typically, I'll advise my clients between age 25 and 45. So what? Be aggressive. At 45, you could start pulling back. Go from aggressive to conservative, to moderate. At 55, go from moderate to conservative, so that you have enough money to recover whatever had gone down. But at the end, all this stuff about the economy going down, it all catches up. So now with the discrepancy I showed you, the guy who is investing conservatively, maybe their money grows to 400,000 at retirement. The moderate guy may grow to 750. The aggressive guy may grow to 1 million. So because you're putting the same amount of money doesn't mean you'll get the same results at the end. And let's say you started this at 30 years old, but it doesn't matter when you start. So if you're doing that and you're with the same company, remember your income is going up, very likely. So it's not always going to be 6,000. I'm just saying match it. But if you actually have expendable income, you don't have to just put 6,000. Every year, IRS comes up with the maximum amount you could put into a qualified plan like a 401k or an IRA. All these things are just IRS codes. It could be called 401k. It could be an IRA if you work for yourself, individual retirement income. It could be a 457 plan. They're different. If you work in a hospital, it's not called a 401k. It's called a different, I think it's called 457. If you work for a non-profit organization, they're all qualified plans. They do the same thing. And those plans have limits every year. Last year, I think it was 24%. So you could put up to 24,000 into that plan if you want to. Your company is only going to match 6%. Your company is only going to put 6,000 into it. But you should take advantage of this. It's for your retirement. You need to be in your company 401k. I started out saying that we are going to address other things today, but I'll leave it with those two. Life insurance is an absolute necessity. 401k is an absolute necessity. Next time I'll get into the other things I wanted to address. I don't want to bore you too much, but please, it's time to have a change in our thought process. All these organizations we have that we go and argue about a lot of things and contribute our dues and all that. And we need to include in our agenda at least one meeting a year. There are usually 4 meetings a year. At least one meeting a year needs to address the issue of life insurance and the issue of taking advantage of the benefits we have in the different places we work. I'm very sorry. I know I was very, very in your face, but that's my job. We all have jobs. You don't have to, if you don't like what I'm saying, delete or shut it out. If you like it, share, share, share. This is in the interest of our community. Good things are not always comfortable to discuss. But when we address them and we do it right, in the end, it's a beautiful thing to do. Ladies and gentlemen, once again, this is Fred Nwankwo coming to you from our studios in Chicago with another edition of Bold Talk on Allen TV. And until next time, good night and God bless.
Max, if you bunye go kwanumo no fube nazo olaga ni piazugo mma olaga do ni piazugo akwa nwa mwilochi biko rapuzo kona bazia edogu kenenu bikechofo kwa mnika kugodia waligwe kwelo ikeja babana bage hey you edogu kenenu bikechofo Oligwe kwelo ike jọba bẹ̀rẹ̀ bẹ̀rẹ̀ ìwọ.
Egwu kampụ na-ekene ọmọgọ ndị nsọ Chukwu Emeka Lumo Ikechukwu na-egaji ezi nwanne m ekene ịlapụlụ ife niile na-eme wee bịa ka gosili na anyị na gị bụ nwanne Wisdom ga-adị ka nye gị maịkị ka ogobanya bụ egwu isili mmaksi ọ bụ na-etiri egwu a malụkwa malụ n'imego m ife ọjọọ wee sị gị nwanne m ife ọkụ na ịchọlụ na ngeme Wisdom onume ekene gị gbamanwụ iyo iyo biko lapụ na masị ya
Zoro, 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 zoro. Zoro, 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 zoro. Duru joy na bugwa Hausa Sokoto Ujembe nwilo Anụ solo nwe nwe manọfịa n'ara